Welcome everyone. Great to be hosting this webinar today. Along with me is Dinesh, my co-founder, Nilesh Sharma. He's our chief tax officer, and our special guest Srikanth, founder at Cache, and Aaron from the Cache team. And I am Hemant Gangulia. I'm the founder and CEO of INRI and Rally Tax. We're backed by Y Combinator. And Man, we're seeing like a great number of registrations today. I remember like this weekend talking to my team, and it was like, hey, we don't have even 100. How could we get, let's say, 500? And now we are at like 950 odd. I hope, I wish we had crossed 1,000, but no worries. We still are at. Okay, now coming to the topic today. It's a very interesting one. I'm sure everyone in the room, probably have got RSUs, and that's why they're here wondering like, RSU seems to be simple. I got it, maybe, I kind of sold it and I still have it. What's the fuss about it, right? Why does it matter? And why does this webinar should exist, right? But I think I can tell a story about myself. Like I worked at Meta before and Walmart. I've seen that RSU cycle, and it's always challenging to understand what is the right time to, kind of liquidate or use this kind of a big money, which forms a significant share of our compensation, right? And if you are actually sitting on a, few hundred K or even a million, I'm sure like there's something to worry about, or at least think, right? What is the right way to kind of manage this risk? And this is exactly what we're going to discuss. And we have Srikanth, who's actually an expert at this. And so I am looking forward to hearing from him. Now, before we get started, I also want to introduce Rally. Why does Rally exist? What is it about? So Rally is an AI native tax advisory platform. And the idea to build this was primarily a problem that we all see, particularly as high income earners. And high income earner would be, someone who's making maybe more than 200K in joint income from all sources, right? And the challenge we have is we have sometimes, this tax complexity, like more sources of income, or, we cannot do DIY because we're unsure if we are doing it right. There are platforms out there like TurboTax, H&R Block, and many others, but may not really fit us or suit us because of this complexity. We have the CPAs, right? But I'm sure like everyone has a challenge working with the CPA. If you have a great CPA, please let me know. But I have not found one yet. So that's why I built Rally. And now that's the goal. We believe like a solution like Rally would be 10x better in the AI world, particularly where, a lot of it is possible now. Imagine an app or a platform that's plugged into your finances and is able to import data and make things easy for you. And so you have more control over your data as well as have full visibility. Imagine talking to your tax documents and just knowing more about it. So I don't think this exists today, even with TurboTax or any CPA. It's more probably driven for them rather than for you. And I think here that's where making that change, that we give the power to you. Now, the first launch that we are doing is this a tax plan. You could cut your taxes in 60 seconds. Essentially, we help you get a tax plan, which is discovering potential savings, what you could save given your 1040. And we will be doing a quick demo as well around the meeting, after the webinar. But essentially, you could get a quick handout of, what your taxes look like. We'll list down multiple of these strategies, and one of them could be, let's say, RSU diversification, which we cannot discuss today. But there are tons of things that could be done to manage and reduce your tax liability. We'll share this link in the chat. As you feel, during the webinar, please feel to try it out. In terms of the onboarding, we are right now invite only, but there is a wait list to do join in or sign in for that. We are offering early access to people who are most excited to work with us. So we will know that when you download a tax plan. So make sure to do that. And with that, let's get started. Over to you, Srikanth, and do share a quick background.
I'll do.
You can do, yeah, your best
Should I
job.
share my screen?
Yes, let me do that.
I think you need to approve.
Try now.
Great. Hey everyone, great to be on this webinar. Let me just adjust my screen so that I can see you guys. I'm Srikanth. I'm based in Silicon Valley, as I said, and I started Cash based on my own experiences with managing a large stock position that I had inherited from a previous employer. And the value prop for Cash is quite simple. We are building a modern wealth platform for folks that hold a concentrated stock position. And as you land on a website, it's at usecash.com. It is very clear who it is for. It is for folks that have a huge amount of their net worth tied up in one or two stocks. This might be folks that have worked at, let's say, Microsoft or Apple or Airbnb for a long time and accumulated a lot of RSUs that have also ballooned in value, or you were a prescient investor and you invested in Nvidia and Palantir and a lot of other stocks at the right time. And now you have this portfolio that is somewhat over indexed on a few names, one or two names. That is who we typically help. The reason why I said it's kind of a modern wealth platform for concentrated stocks specifically is that there are lots of like financial apps that you might already be using, like a Schwab or Fidelity or Robinhood. The way that I think about it, they're all financial superstores. It's kind of like Target, you get everything under the sun, but if you have any specialty needs, that's where they are kind of lacking. And this is something that's not a new problem. Concentrated stock positions has been on the radar of like private wealth managers for a long time. I think in the 1950s, 60s, when executive pay became a much larger part of like their executive pay in stock became a much larger part of their compensation, a lot of these efforts kind of sprang up. And like the whole value prop that we offer is your financial future riding on one or two stocks, you can diversify without a giant tax bill. And it is an age-old instrument called the exchange fund that has been available through one or two major providers. It's actually two major providers, but you needed this $10+ million net worth to be able to access the private bank that will get you a slot into one of these exchange funds. So it's typically been a very high net worth product. Most folks have never heard of anything like this, let alone have an access to even use it. That is the problem we set out to solve. We'll go through what an exchange fund is and how it can help you. But before that, I also wanted to quickly say that we have multiple products for folks with concentrated stock positions. We also have something called the Caller Advance. Typically, you might be familiar with margin borrowing. You can just go to the broker and borrow against your stock, but you also have margin risk there. If your stock falls, you will get a margin call and you might be liquidated at an untimely, which might not work out for you. And we also have stock lending, which is a way to earn passive income on the stocks you're currently holding. Most often, like the brokerages that you are holding these stocks in are lending them out. We are just lending them out and passing on the income back to you. So today we'll mostly talk about the main product that we offer, which is called an exchange fund. And I'll go through how it works, how it can help, and why somebody should consider it. Just to kind of give you guys a quick background on who we are, I come from having been through this problem myself. I used to work at Waymo right before I started this company, and I like to say that I was working on self-driving cars and one day decided to be an asset manager. But I was trying to solve this problem that I had encountered with my previous employer. I was an early employee at Uber, and that stock itself had done really well and grown to be a huge part of my own net worth. And at 80 or 90% of my net worth, I was trying to chip it away, but also getting hit on huge amounts of taxes. That's when I hired a wealth manager and they told me about exchange funds. And I was like, how is this not something that anybody knows around me? All of my peers at Alphabet had much bigger problems than me. They were at Alphabet since pre-IPO, and they're telling me they've never heard of something like this. It seemed like a huge opportunity that nobody has tried to kind of make this more easily accessible. That's how we got started. We got started about 3.5 years ago. The first 2+ years we were in stealth, and about 18 months ago, we launched the public. We also have Aaron, who is going to be presenting today as well. He comes from a wealth management background. Do you want to give a quick intro, Aaron?
Yeah, thanks, Srikanth. Hi, everyone. Aaron, head of investor solutions at Cash. I'm a certified financial planner. Early in my career, I worked for an accounting firm. I valued privately held companies and their stock options. I also did some individual tax returns as well. More recently, I spent 16 years in wealth management. I was chief growth officer at a group called Adero in the Bay Area. We were a $4.5 billion RIA, and many of my clients were tech engineers and executives with a heavy amount of equity compensation. It was quite common to see 80% or more of their net worth tied to one or two individual stocks. And it was typically the result of holding on to RSUs over the years. They had their monthly or quarterly vesting. They were busy with work or with family. They didn't pay much attention. And those stocks over time built a significant amount of exposure. and a significant amount of wealth. And with tax rates approaching 37% in California, as you might imagine, many of my clients were reluctant to sell. And so that was a challenge for me as an advisor to figure out a way to help them shore up their financial plan and protect their wealth they accumulated, but also while being tax sensitive. One of the most effective tools that I used was an exchange fund. However, many of the larger providers at the time didn't have capacity for a lot of the tech names that my clients held. And so usually I would wait 3 to 6 months to be told no, similar to Srikanth's story when he had his own concentrated position in Uber. But in late 2023, started researching alternatives, talked to Srikanth and the Cash team. I completed diligence on the behalf of my advisory firm, and we rolled that out broadly across our advisor group and our clients, and had a really good result. A lot of our clients participated in the initial exchange fund launch in early 2024. That helped reduce concentration risk right away while deferring tax, and it shored up a lot of the financial planning outcomes for many of my clients. And after working closely with Cash Team for over a year, I decided to join the company full time to focus exclusively on providing tax-aware solutions for people with concentrated wealth. So that's a little bit of my background, but we'll share more as the webinar goes on today.
Great. Thank you, Aaron. Our investments team is also headed up by somebody with a lot of institutional pedigree. Christopher Lange, who's our head of investments, he was a portfolio manager at Goldman Sachs for over a decade and worked with a lot of portfolios where he saw the need for concentrated stock solutions. When we were on the market looking for a head of investments, connected with us, and he's been there for 2+ years at this point. So concentrated stock positions seems like such an esoteric topic. Nobody has built a company around it. Nobody seems to think about this as the next big idea. But why are you focusing on building a company around it? It is surprisingly large, but also fully ignored. There have been, you go to Goldman Sachs, there'll be a desk that focuses on helping folks with concentrated stock positions, but nobody has built a brand and a company around this particular challenge. That is what we set out to build. And when we looked at the trends and how just stock compensation is generally going, you look at this graph of Mag 7 spend on stock compensation, Google and Amazon just by themselves, I think this is actually 2024, they spent 22 billion in 2024. I think the number was closer to 25 billion in 2025. That is the amount of stock that is being issued to employees every year. And on top of it, all of these companies have done really well. If you look at the Googles or Amazons or Apples, they're all 10+x over the last decade itself. And you have the NVIDIAs that are probably 100+x. That creates these portfolios where you might have had 5% of your net worth in NVIDIA. With the growth, it's suddenly 80% of your net worth. That is the problem with the way stock market returns are concentrated in a few names. And that is what we help with. The tax burden becomes the biggest barrier to diversifying and going towards a more, I would say, de-risked portfolio. Most of them don't even know that something like an exchange fund exists. This is something that's fairly obvious, but one thing to remember is, as I was talking about, the concentration at one point in your wealth accumulation is what builds great wealth. Concentration is in your portfolio is useful to bring about great wealth, but once you have a huge amount of your eggs in that basket, it is best to de-risk and diversify so that you preserve the wealth that you built. And whenever you look at a long term over the S&P 500 or the Nasdaq 100, most of the stocks underperform the index over a long enough time frame, and it is very hard to predict which ones are going to be the ones that will slightly outperform. And when you adjust it for a risk-adjusted basis, very few will be outperforming the index, and you're essentially hoping for a lottery ticket. So if you have too many of your eggs in one basket, the obvious solution is diversify away some of that risk. How do you do that? The easy way, and one that everyone knows, is I can just sell the stock, and with the proceeds that I get, I can diversify into an index fund. But when you have highly appreciated stocks, the minute you sell, you're incurring huge amounts of taxes, especially in New York or California. It might be 35+%, and that is a huge hit to take. And your portfolio will take many, many years to get back to the starting value that you were at. And that's where an exchange fund has been this amazing solution that has been almost a secret. You can start with 100% of your capital and invest it into a diversified portfolio and let it grow in a tax-deferred manner. And there are certain rules which I'll talk about, but you get tax-deferred compounding and keep deferring taxes as long as you don't need the liquidity. So the way an exchange fund works is quite simple. It is actually backed by the tax code. It is called IRC 721. It's a statute in the tax code. What that IRC 721 says is there's a non-recognition of gains or loss when investors are contributing to a partnership that is structured a very, very specific way. So in this image that I have a common pool, which is this fund that we're going to be forming, and lots of different people with different stocks, and each one of them is concentrated in one stock. And us, as the exchange fund manager, can work with hundreds or thousands of these people and bring them together into a pool in a carefully balanced manner so that the fund or the pool that we create starts to behave like an index, whether it's NASDAQ 100 or S&P 500, and everyone gets shares in this fund, which means they're completely diversified and following a much broader index, but they did not incur any taxes. There are certain rules that you need to keep in mind. One is the tax law says that investors that are getting into it need to hold for at least 7 years before they can withdraw a diversified portfolio. And withdrawal of a diversified portfolio is also tax-free, which means that you do not incur any taxes on redemption. You contribute the concentrated stock, it goes into the pool, it follows along benchmark to a broader index, and when you redeem after many, many years, you can take a basket of stocks, or in our case, an ETF as well, and keep that in your portfolio until you need the liquidity. So your portfolio enjoys tax-deferred growth, and once you have a larger base, it just naturally compounds faster. That is the basic idea. How is it that nobody has heard of it, and what is the problem that traditional funds typically had, and what is the big unlock that we came up with? Aaron can talk about his own experience with exchange funds and also tell you how our funds are structured.
Yeah, it starts by looking at where the economy has grown over the last 20 years. There's been a significant imbalance across the different sectors, with technology and consumer discretionary leading the way. And you just don't have as much growth or need for an exchange type product in sectors like financials or materials. And given that the technology companies also have a much higher amounts of equity compensation, sometimes 3 to 5 times what you see in the other sectors, it creates a big backlog of people with stocks and a significant problem and a lot of risk in their portfolio, but no way to address that issue. When I was an advisor, a lot of my clients were in the top 2 bars here and had a lot of stocks that would be acceptable to an exchange fund, but the exchange funds used broad market indexes, either S&P 500 or Russell 3000. And so for every share of NVIDIA that they accepted, they'd have to go and find a Home Depot or Coca-Cola or another stock to help maintain the overall balance. And so what ended up happening was people just waited for years and years, and they never were able to get into an exchange fund, and they gave up trying and just sold and paid the tax. And when you look at some of the different companies across these sectors, the one that comes to mind, back up one sec, the one that comes to mind most for most of you in technology is probably NVIDIA, right? Hit $5 trillion today. Everyone knows that company. But when you go down the list in the sector like industrials, the fastest growing company there is probably one you've never heard of, Ferguson Enterprises. They do plumbing and HVAC equipment. They've had a 10x return over the last couple decades, and they're only $50 billion today. Or take financials. MasterCard has had 100x return, but it's still only 500 billion, which is 10% of the NVIDIA value. So, that's the problem. And so it's very difficult to build a broad market exchange fund when you have this constraint. And so we've addressed that problem in 2 different ways. One, our initial exchange fund that launched a year and a half ago was based around the NASDAQ 100. So just naturally, there's higher capacity for high growth stocks and in tech, but that still has a limitation as you start to move outside of NASDAQ exposure to get to more broad market, which makes sense for some people if they want to balance their portfolio and have indexed broad market with some of their concentrated stock that they hold for the long term, and that can be a nice complement. And the other way is to use an ETF to rebalance. And so this is something that we've created, and we're the first exchange fund to market with this particular innovation. And for the investor, Process is the same. Your concentrated stock slides over into the exchange fund. Your cost basis is maintained. You're deferred. You're immediately diversified day one. After we're done pooling some stocks in the exchange fund, we can perform what's called an ETF rebalance, something we call index sync. And this is a way for us to fill in some of the holes in the index that we don't see organically in the enrollment pipeline. Srikanth talked about code section 721, which is contributions of property to a partnership. There's a similar code section 351, which is contributions of property to a corporation. In this case, the corporation is a newly formed ETF that's having an initial public listing, and the stocks are contributed at the time where the ETF is coming to market. The unique thing about ETFs is that they have a tax shield and the ability to selectively rebalance positions to better align to the index over time. And it's not considered a sale. It's through the ETF creation and redemption process. And the ETF managers will work with an authorized participant to swap certain stocks that are maybe overweight for stocks that are underweight to better align and track to that index. So this is a major unlock for us, allows us to help a lot more people with the stocks that are growing the fastest, allows us to have tighter tracking towards the index as well. So yeah, I mentioned higher capacity for appreciated stocks and tracking towards the benchmark. We have 3 different benchmark choices. So we've got a broad market S&P 500 fund, as well as a NASDAQ 100 fund. We'll be launching our S&P 500 growth fund here in a couple weeks. And so in terms of the growth and technology weights, that sits right in the middle between the 2 existing funds that we have. So now we'll take a look at some results. Bedrock is our S&P 500 benchmark exchange fund. This launched in July. It currently has over 450 individual stock holdings. It includes an ETF component. So that's the look-through exposure into the ETF, which is well diversified and tracking to the S&P benchmark. Beta, which is a measure of how tight that portfolio tracks to the index and how, like, a measure of volatility. 1.0 beta is perfect tracking. 1.03 is slightly more volatile, but still quite good. The next measure, TE, is tracking error, and so that measures the variability of the returns. And 1.65 falls below our long-term target of 2 to 4%, and so it's tracking well. Performance is slightly favorable, although I'll say that that's a function of the ramp-up period, and so it takes a little bit of time for us to build in all the right components of the exchange fund, and so the fund may have a little bit of a wider variation in the early months. And then on the right side here are the sector weights, and this compares the S&P in the light yellow with our exchange fund, and you can see very tight alignment across all the different sectors of the benchmark. And the next slide is Unix. This is our largest and longest running exchange fund. This one launched in August of 2024. It's close to $500 million today. The correlation is 0.99, so very tight to the index. Slightly higher beta, but still quite close, and a little bit higher than the tracking error. But good sector alignment across the board. So we'll spend a couple minutes here just comparing some of the differences, and I can speak firsthand because I use some of the other exchange funds directly for my clients. Big difference, we have a lower minimum. 100K is the entry point. Typical exchange funds are 500,000 or $1 million. The other difference is that we have an exchange fund for accredited investors. And accredited investors, anybody with 200,000 of income for the last 2 years or 300,000 with a spouse. You can also qualify under the net worth test if you have $1 million or more, excluding your primary home. We can provide an exchange fund option for you. The other exchange fund providers work with qualified purchasers. So these are people that have $5 million of investments, and so it's a much higher threshold to meet. But we have funds available for both, depending on where your wealth is at this point. The other thing, I think, as a shareholder or as an investor, having flexibility around the timing of when you would contribute your stock. We have company earnings, you have trading windows around your employer policy. The traditional providers may only have exchanges 2 to 4 times a year, and that may not fall within an open window. We provide flexibility there. We have an exchange every 2 weeks. We also have a fully digital onboarding experience, everything through our investor dashboard. You can be diversified out of your stock within as little as 5 days. Folks can sometimes take weeks as you work through their their paper forms and email process. And then the last difference is on the fees. Our minimum investment size 100K starts at 0.95. As the overall investments go up, the fees come down. At $500,000, you'd be at 0.7 million, would be 0.6, and there are some higher tiers of the contribution scale from there. Traditional exchange funds can be up to 1% a year in a management fee, and up to 2% of an initial sales fee as well. We also can work directly with investors. You don't need a financial advisor. All the other providers out there require you to work with somebody at an advisory firm. I touched on the different strategies. We've got broad market to growth. The other providers are typically more broad market focused. We've got an ETF component in our qualified purchaser funds that allows us to better align with the benchmark, and we can and take higher amounts of the tech stocks. We have no minimum holding period. Both exchange funds have a 7-year hold. That's just part of the tax code. But after 7 years, we're able to provide ETF shares that you can hold long term. That's still tax deferred. And to the extent that we have some individual stocks that we distribute, that basket would be like a 351 exchange compliant. So you could take that basket of stocks, go to an ETF provider, and have them convert your stocks to an ETF. So ultimately, you can end up in a low cost benchmark tracking ETF that is easy to manage for you long term.
Great. Thank you, Aaron. So we shared a little bit about how an exchange fund works and how we've innovated, but the other part of it is you're trusting us with a lot of capital. And one thing we made sure when we were in stealth for 2+ years is making sure that we build a platform that investors can trust with a huge amount of their capital. And we structured our funds and our entire process very, very carefully so that trust is built into like the way we offer the product itself. First point to note is that each of our funds is owned by its fund investors, and all we are is an advisor to the fund that is helping put these together, but we do not have any equity ownership in any of these, and we actually work through an independent custodian as well as an independent fund administrator. The assets are held at Bank of New York Mellon, which is currently the largest global custodian. I believe they hold $55+ trillion of assets and are used by the likes of Vanguard and BlackRock and the like. So a lot of the largest investment firms that you currently work with, their products might be held at the same custodians. Next, we are a registered investment advisor as well as a broker dealer, which comes with a lot of expectations and responsibilities and the need to follow certain regulations, which helps us within a narrow track and makes us accountable. And there is independent oversight. Each one of our funds goes through an annual audit, and each investor has access to that audit, as well as there is a fund administrator through whom we are doing all of our transactions. And a little bit about how the company itself is funded and structured. We were very unique in that we attracted capital from lots of leaders in Silicon Valley and Wall Street. I believe we have 75 or so angel investors, lots of CEOs and CFOs and folks that have seen concentration in their own portfolios, or folks that have been on the other side on Wall Street and seen products like this built, but not able to serve a broad enough audience. Our VC investors are first round capital, who were also initial investors in Uber, Notion, and Square and the like. Total, we've raised about 21 million across seed and Series A, and we're already profitable, and we have a healthy balance sheet that can help us operate indefinitely at this point. So just a little bit about our progress. As I mentioned, we launched about 18 months ago, and this is something that the market had a huge void in, and that shows in the adoption curve that we've seen. Just about 18 months later, we are already at $925 million in assets. The average client differs almost 800K in capital gains, and the average investment is over 900K. And as you can see with the slide below, a lot of our clients are some of the who's who of Silicon Valley or Wall Street. Many C-suite executives across major tech companies are some of our clients. That's a little bit about cash and its exchange funds. We hold closings every 2 weeks. So the next closing is on November 15th or December 3rd. December 3rd is one of our larger closes where we'll coordinate closes across all of our flagship funds. So there'll be a lot of capacity for any stock that you're concentrated in. That is mostly what we wanted to share. Happy to answer questions. And you can also ask Aaron about how he helped with the RSU planning for his clients as well.
What is your recommendation if an employer is getting ESPP from their employer? Should they go for it, or do you think it's better to not go for it?
So all of this depends on a simple calculation, which is what is your embedded gain, and are you better off just selling it, or deferring the taxes that you own? So we have built a calculator where you can just go in and let's say you received ESPP from Microsoft. Today it's worth 400,000 and your cost basis in that was about 60,000. It tells you how much of an advantage an exchange fund would give you over time. Tax deferred compounding is a very, very powerful concept that most people do not easily understand. But every dollar of taxes that you do not pay today is working for you and continuing to essentially compound within your asset base, and you defer the taxes until you need the liquidity.
I agree with you on the deferring of income part for tax purposes. So are these only applicable for stocks that have been vested through, let's say they are getting stocks through options and other forms, or can they even use the options that have just been awarded or granted and not been exercised yet?
This only works for stocks that you hold in your name. After they're vested, after they've been exercised, we cannot take any derivatives or any contracts.
And can a private company that is pre-IPO, can we use stocks from that company into this exchange fund?
Not currently. We only allow for public companies, since most of these indices that we follow are NASDAQ 100 or S&P 500 built around public names. That's not to say at some point in the future we might allow high quality private names into our funds.
I think you already answered this question, but is there any specific ETF that someone can use to compare to what fund that?
Yeah. So the ticker is called AAUS. And that is who we worked with. It's a firm called Alpha Architect. They are an ETF innovator, and you can just go and look at Alpha Architect and let's say compare it to over the last 1 month. You can see that it is following along quite well, and they're running parallelly. It launched in July, so there's no 6 months of data.
Got it. The next question they have is, this is tax related, but I'm not sure if you have any insight on this. Do they need to hold RSUs for more than a year to make it a long term? I don't think long term or short term really matters for exchange fund. Right?
It does not.
The next one they have is,
especially if you're, let's say, at one of the Palantirs or one of those companies that had an
Oracle
intra-year doubling or tripling, you might want to,
like Oracle or.
The cost basis slides over in your holding period tax into the exchange fund. So if you were at 6 months when you contributed and you spent 6 months in the exchange fund, you would get to long term by the time you finish your 7 years and take a redemption.
The next one I have is, are there any tax implications? I think you answered this as well, at the time of entering into an exchange fund or exiting the exchange fund.
The current tax code treats both entry and exit from an exchange fund as non-taxable events. So you get put in what is called an in-kind contribution. You put in stocks and you get an in-kind redemption, which is a basket of stocks or ETFs at the end. And both of them are non-taxable.
Got it. So it's very similar to a 1031 exchange that real estate people do.
So yeah, 1031, 721, and 351, you can think of them as like kind exchanges, and they're all cousins in the tax code.
This is interesting. Can 401k funds be used for contributing into an exchange fund?
So 401k is already tax advantaged, which means you can sell within a 401k and not incur any taxes. It only matters in a very specific case, which Aaron can speak about.
Yeah. So if you have a 401k and you've purchased employer stock, over the years, and maybe you've been at a company for 15, 20 years, you're getting close to retirement. There's something called net unrealized appreciation, NUA, and you can take an in-kind distribution from your 401k of that stock. You'll pay tax on the purchase price of the stock, whatever you deferred from your paycheck to buy the stock or any employer match. If the stock's done really well, that might be 10% of today's value. But the stock comes over, you pay a little bit of tax. Those shares then can be held in your brokerage account. Those would be eligible for exchange, and you'd have a fair amount of unrealized capital gains there. So that's net unrealized appreciation, NUA. I'm working on an article that'll come out in a few weeks on that topic, but you can Google it for now.
There was another question regarding fees before you answered the question about the fee structure. So I think we can move on unless you want to add a little more color into how the fees would work.
It's very simple and transparent. Everything is on our website. And there is just one simple advisory fee. There's no layers of obfuscation that you might find with other private funds and layers of brokers you need to pass.
Yeah. So the next question we have is, do I need to be in a lower tax bracket or have to worry about taxes when I get back? I guess we covered that already.
Yeah, since it's not taxable, you can hold until you want to get out of it, or you're in a lower tax bracket and optimize for taxes that way.
Makes sense.
Yeah.
Now I'm reading through the questions directly. So what happens if this cash gets bought over or shut down?
Yep. So that is one that I answered over here. The way we've structured each one of our funds is that it is a separate legal entity owned entirely by its investors, and the assets are held elsewhere. There's a third-party fund administrator, and all we are is a legal agreement with the fund that says we are the advisor. And when you think about it, the hard part of exchange funds is assembling all of these different people and saying yes to this person, saying no to that person, saying yes, but only this much to this person. And that is the hard work that we do and carefully put together these portfolios. If something were to happen, that responsibility can be handed off to another registered investment advisor, and they can carry on the duties. The management part of the exchange fund is not the hard part. And as I also mentioned over here, we've scaled rapidly and we're generating significant amounts of revenue. The going concern is not a concern anymore. We can fund ourselves indefinitely at this point.
There was one more question related to the same thing, but on the other side, let's say someone puts in their RSU of a company from where they worked before, and that company gets bought over. What would happen in that situation?
That is one that is a little bit more nuanced. It depends on many factors. One, did the company get bought over for cash or stock, or was it a mixed deal? If it is an all stock transaction, it just gets swapped over. But if it's an all cash transaction, it is what is called a mandatory corporate event, which means that every shareholder realizes the capital gains. Next, we have something called an ETF rebalance that we talked about, where we might have rebalanced some of the stock that came in through the exchange fund, and we might no longer hold that stock. And within an ETF, they might want to rebalance some of those M&A transactions as well. That might I would say, obfuscate the tax implications of that particular event. But if it were held in an exchange fund and there was what is called a mandatory corporate event, like we have to essentially pass on that forced taxation up to the person that contributed it.
Got it. So in that case, essentially the gains would transfer back to the original owner of the stocks.
That's correct. Yeah.
There is a quick question on fees again. So the onboarding cost is $7,000 on 100K. I'm not sure how they came up with 7,000, but
no, we don't charge any onboarding fees.
What's the due diligence process for real estate investments? Firms like Fidelity and Eatonvance has huge track record. How does Cash tracks them?
Right. So one thing I would add to that is, as you go through the onboarding process, we have a due diligence questionnaire that you can review and go through all of the steps that we've taken. But this particular question was around the real estate due diligence. The way I would say that is all of the legacy exchange funds, what they did was they went out and bought individual buildings in different parts of America, and you would end up with a few buildings in one exchange fund different set of buildings in another exchange fund. And even though they have a long track record, they're essentially forced buyers. If there is an exchange fund closing in, let's say, end of October, I now have to find like $100 million of real estate, and the party on the other side knows that I have to buy this real estate. So you're a forced buyer. When we looked at the performance of these exchange fund portfolios with the real estate, it didn't seem like it were the best real estate returns possible. The way that we've done is completely different. We partner with who we think are the best real estate managers in the country and onboard onto the institutional funds. So far, our biggest investments have been with the firm called JLL or LaSalle. And this particular fund that we are invested in holds thousands of properties diversified across America and across lots of different property types. That helps us get into a fund that is from day one well diversified and has a long track record of performing against its index that they're trying to track.
Next question is, who keeps the dividend from these stocks?
So the dividend essentially flows back into the fund. And when you have a fund, the accountant that is responsible for striking what is called the net asset value of the fund essentially sums up all of the equity value, all of the dividends, all of the liabilities, and comes up with a new share price. So it just adds to the current value of the fund shares. Right now, we are accumulating dividends in most of our funds rather than distributing them.
What's the average growth rate for the fund? I think Aaron mentioned it in one of his slides.
Yeah. So the way to think about an exchange fund is that it is a wealth preservation tool that is helping you de-risk your portfolio. It is not a hedge fund that is trying to say that we're going to outperform like the benchmark or that we are going to produce alpha. There is some alpha that we've generated in both of these funds, but that is not the core goal. The core goal is to help you diversify and make sure it tracks very close to the benchmark that we're trying to hit, whether it's S&P 500 or NASDAQ 100. There is some opportunistic decisions that we made that led to this outperformance, but that is not our core goal. It is to help you de-risk your portfolio and get into a diversified portfolio.
Makes sense. A question on the tax event. So there is no tax implication when you enter into it. There's no tax implication when you get your stocks back at the end of 7 years. So the tax implication only exists when you sell those stocks that you received.
That's correct.
Is my understanding. Who do you consider a competitor in offering similar services?
In the world of exchange funds, the market has been a duopoly for a very, very long time. And in a way, I wouldn't call them competitors because they do not work at the same level of access that we're trying to provide. As I mentioned, it's only at $1 million or so minimum. It only works for $5+ million investments, and you need to have a private wealth relationship. So it is built for the clients of like large private banks. What we're trying to do is build it for a much broader audience of accredited investors and other folks who are especially in the tech industry and receive a lot of stocks, and how we can help them diversify tax efficiently. As far as we know, we are the only ones doing that.
Got it. Next question. Can we take loan on these exchange funds?
Yes. So that is something we're currently working on. We're working with large banks to help you get liquidity against these, as we are not a bank ourselves.
Are there any restrictions on what stocks can go in?
No, we have a real-time calculator. As soon as you plug in the stock, it calculates based on the current portfolio and the stock that you're entering, how much of it we can absorb and have a portfolio that still maintains its track record and stays close to the benchmark. As soon as you enter that through our enroll, it'll tell you this is how much of this particular stock we can absorb right now.
Yeah, we can take most US listed stocks, anything over $1 billion of market capitalization. Even for our NASDAQ 100 fund, we can take a stock that's listed on the New York Stock Exchange as long as it satisfies one of the sector requirements that we want to see. We can take ETFs. So if you have sector ETFs or some other value or growth ETF, and you want to switch to a different benchmark, those would be acceptable. Mutual funds, however, are not, but many mutual funds allow you to convert. So you could convert your mutual fund to an ETF class, and that would be acceptable to the fund. In case you're wondering, we're not currently taking crypto assets, so crypto ETFs would not currently be eligible.
Next couple, we are almost about time. We'll see how many we can answer. There is a lot more coming through. Can someone who is investing money in request for a custom portfolio of stocks that they want in their fund? Or is it decided by you?
Yeah, so the way I explained the exchange fund works, it's a good slide to be on. There is somebody at the center who is pooling all of the stock and managing the ratio and proportions of all of these different stocks so that the portfolio starts to behave like a particular index. And we can only do it for very well-known indices that lots of people want to buy into. The minute you go into a custom portfolio, you have to convince a lot of other folks that, hey, this is a good custom portfolio that everyone needs and should want. That is the limiting factor. Once we are at a particular point, we might get into some thematic portfolios or some custom baskets, but most folks just want market exposure through index-like portfolios.
The next question I have is, how do the stocks move from their record keeper for their company to exchange fund?
It is a fairly simple process. What we have built is also a broker-dealer. You create an account with us, and it has all of the steps to get into the fund itself. For a short period, it comes in and sits on our brokerage, which is held by Apex, the same clearing broker that I believe Wealthfront, Betterment, eToro, and a bunch
I think even Robinhood uses them.
Yep. And from there, on a particular close date, it is absorbed into the fund.
Awesome.
Yep. One thing I would add, just while we have the time, is they have invested a lot in making sure that all of these questions are answered. So there is a help center on our website that you can go through and learn. And there's also this chatbot where you can ask any question. We have trained it over a long time, and it does a very good job of making sure it gets to many of the questions that I answered right now.
I like the name of the bot, Cashier.
Thank you.
Last question, I think. If you guys have time, we can continue to take questions, or
Sure. Yeah.
we can stop.
Yes.
However long you have. Can someone get out of this fund before 7 years or over if they have some personal requirement that they just have to get out?
Yeah. As I mentioned, the 7-year is the diversification window that is defined by the tax code. It is not a lockup of any sort. What the tax code says is before 7 years, you can only get the assets that you put into the fund. So before 7 years, let's say you started with Meta and you contributed Meta into the exchange fund. Before 7 years, you're only eligible to take back Meta stock. After 7 years, that magical number you can take back.
Sorry, someone got
What do you like?
No, Hemant, can you mute? Awesome, thanks. Awesome, that makes sense. And they would get whatever growth Meta has or whatever value of Meta has.
No, so that's not how it works. When you contribute Meta, you get back fund shares, and you're just tracking the fund shares. When you come back, let's say 5 years from now, and say, I want to withdraw some Meta for whatever life event, you're essentially exchanging back your fund shares for Meta shares, and you're going to follow whatever the fund performance has been.
Okay, so if the fund has grown during that period over Meta stocks, then you would still get benefit of getting the stocks back.
That's correct. Yes.
So you don't lose the benefits of being in the fund.
That's correct. Yeah.
Awesome. Next question is, can you hold these funds if you move away from US?
Yeah, if you are a US resident and you have US tax implications, you can get into those. From what we understand, that tax implication doesn't go away even if you move out of the United States. And yeah, it is entirely possible for you to hold.
But if you are moving out and you have tax-related questions, do feel free to reach out to us at INRI. We can help you understand how it can help. There are a few ways you can save a lot of taxes. 401k stocks on which tax is paid on pre-tax money. I think we have answered this one already, but there is an additional component to it. Will that be eligible for step up at the death of taxpayer?
Yeah, any stock that's held outside the retirement account that's appreciated would follow the state tax rules for a step up. If community property, you get 2 step ups. If it's separate property, you get half a step up. So I would, again, I think consult with your tax advisors here on the call.
Nice. RSU or stock from past companies or current company. So RSU or stock from past companies, or it can be from current company while you still being employed by the company. I think the answer is yes.
Yeah, it is, but some companies might have restriction like trading windows. You'll need to follow those. They might also have restrictions around particular kind of instruments. Most companies say you cannot borrow on margin. Many companies say you can't trade options. Some companies might even say you cannot do exchange funds. From what we know, most of the Mag 7 and many major tech companies
That I
are
guess.
okay with it, but it helps to check with your equity team.
Awesome. So one question is that you briefly mentioned before is the rebalancing of funds. Let's say one of the investors brings a huge amount of stocks from one company. How does that factor in?
Yeah, so we have a very large platform where there isn't really danger that like there's only one investor with a particular stock. Most stocks, we have so many investors and so many investors waiting in the queue that it can easily be rebalanced out, even if somebody were to leave. And many stocks can act as proxies for other stocks, even if there's a temporary imbalance or like we do not have a particular stock. A lot of stocks in that sector behave like that particular stock. Those can proxy for that particular stock for a short period of time while we fill that particular hole.
And from tax point of view, there has to be a cost basis attached to these stocks, right? Especially when you're converting them into a basket of stocks at the end. Who manages that cost basis and how is it allocated?
Yeah, we do. Our accounting platform keeps track of all of the lots that you have come into the exchange fund with. And when you're redeeming, we calculate what the cost basis of each one of the stocks that is being delivered to you will be.
Do you guys account for loss harvesting while you're managing the fund?
Yes, we can do loss harvesting within the fund. We haven't done a lot since most of the stocks that we get are highly appreciated, and it would take probably like 50-60% drawdown for them to enter a territory where we can harvest losses. But over a long enough time period, let's say 7+ years, some stocks will do really well, some stocks will not do so well. And when we give you a basket, we can give you a basket that has loss harvesting opportunities.
Awesome.
Because,
I think
some stocks have fallen below basis.
Got it. I think we have answered rest of the questions. I'm just making sure.
These are all really great questions, very, very thoughtful. Thanks for the audience to come up with all of these different questions.
We have one new question. Can capital gain from an existing investor get passed on to remaining investor who are still in as part of the fund?
There is no adverse effects that one investor would have on the rest of the fund. If there is a capital gain realization in a certain way, that feeds back to that particular investor.
So the gains stay with the investor who contributed into it.
That's correct.
Don't pass on to rest of them.
That's correct.
Makes sense. I guess that's a follow-up question. How is that managed to ensure that it only sticks with?
It's just how the tax law itself is written and how some of the allocations of realized taxes flow through in a partnership.
I guess we captured all of them.
Yeah, and I think it's possible we may not be able to answer or may have skipped questions. So feel free to email us or reach out to the Cashier team. Our email is hello@rally.tax. So yeah.
Our support@usecash.com. You can reach out on that email. You can reach out to me on LinkedIn, whichever works.
One question that I missed. Most of the stocks that we discussed were tech-based stock.
Yep.
How do you get stocks from, let's say, healthcare or manufacturing side into your portfolio?
Yeah, as our platform has grown, the distribution has grown, and we are, the way that I think about it, we're essentially casting this very wide net over the internet, and we regularly get folks from all parts of the country. One day we might be onboarding Colgate-Palmolive. The next day we might be onboarding like Home Depot, Costco. We get a lot of energy. We get a lot of healthcare. It is essentially a distribution problem. And if we do not have the distribution, we just do not close. If we cannot deliver on the promise that the fund, the objective that the fund has said, we just hold back. Otherwise, we could have just kept growing by onboarding NVIDIA and Apple and Meta.
Got it.
Srikanth, could you quickly show everyone on the call how to check for capacity? Just show them the link or the enroll.
Yeah. So if you go to usecash.com, it's very easy. You can get started, and over there you can quickly check on any particular stock and it'll tell you.
So you actually use the plus option from Gmail?
Yeah. To create all these.
I use it, but I have never seen anyone else use it.
Yeah, so I entered like $1 million of Apple. It tells me which funds I'm eligible for. Unix, which we talked about, is a NASDAQ 100. Bedrock is at S&P. And this is the new one that is launching called Mosaic, which is around S&P 500 growth. I can just go into Unix and see like the current fund size is 493 million. These are many of the stocks that are currently held. I can see the table of all of the different stocks that are in the fund right now. The cumulative performance, and as I was saying, you can look at the documents as well, and there's a lot of FAQs throughout to help you. And as you go through, the app will tell you how to move forward and complete the process as well.
Awesome. There are still more questions coming in. I think we can. Do you want to take more questions or?
Let me just check my calendar.
I have a hard stop in the next 3 minutes.
I can take over.
Yeah.
Yeah, I'm free till 4:30.
Okay, awesome. So how do you decide on 20% illiquid investments which will be in the fund?
So the 20% illiquid asset requirement is part of the tax code. That is what allows for this tax deferred contribution into this exchange fund. It is written in the tax code that it should follow this.
And the one question before this is, when the 7 years are over and the fund is closed, does the stocks or the pool of stocks move into a larger pool or before someone withdraws it? Or how does the things work after 7 years are over? So
each of our funds is a perpetual vehicle. Investors can come in and out, but the fund itself keeps carrying on with its objective of NASDAQ 100 or S&P 500 or whichever new objective we might come up with. So there's no need for it to move into a larger pool or smaller pool. As long as there is the right balance within the fund, we can continue to provide that particular service.
There is a follow-up question on that 20% thing. Sure. So the question the answer he was looking for is, how do you decide on which assets are to be part of that 20% illiquid category?
Got it. So there is a whole list of things that are defined in the tax code that qualify as illiquid assets, and all of the stocks, money market funds, cash, and a lot of other things, even REITs, do not qualify. And when you cross off all of those, you're left with the very finite set of things that you can invest in. Commodities is one, and real estate is another. Most of the exchange funds that have ever been built always tend to choose real estate because it produces income, and commodities do not.
Hemant, can you take over
the
next few questions?
Yeah.
I've also got a hard stop. Thanks, everybody.
Thank you, Aaron. Thank you, Srikanth, for your time.
I can stay on.
Yeah, there's one more. How do we expect our K1 to look if we don't redeem or exit?
Yeah, so the K1, we have a sample K1 in our due diligence packet. You can see what the K1 look like for folks that completed 1 year. It is a fairly simple K1 that investors can show their CPA and make sure that they're comfortable with.
One last, which we have right now, is what is the risk towards market drawdowns?
So what we're trying to achieve is index-like performance. We do not take any view on like this is how the market will be, or this is how much performance we're trying to deliver. It's a quantitative exercise of steering this basket towards index-like returns. And if there is a market drawdown, our fund should follow along because we have had an excess alpha. There is a little bit of a buffer, and hopefully we can just maintain that buffer forever.
Got it. There are a few more questions now. Feel free to let me know if this is over. Where can we do day-to-day tracking on the portfolio? I believe that's on the cash website.
Yes, when you log in, you'll be able to see the fund details.
Yeah, and is it possible to transfer from one fund to another, let's say from Unix to Mosaic, and what are the tax implications?
You cannot do that from a tax perspective unless you redeem from one fund and enter into another one. It is quite a complex transaction. So I would say when you enter a fund, be sure that this is something that you want to hold for a long time.
Now there are 5 more questions. Yeah. If we are not selling, what K1 shows?
Yeah, so the K1s are mostly going to show the small amount of activity that naturally occur within the fund. This is all of your dividend costs, the dividend income, as well as the real estate income. There might be some stock lending activity that we do within the fund, which generates income as well, that will show up. But largely it is fairly static portfolio, and the only way we are constantly rebalancing is by adding new stocks. So it shouldn't have a ton of activity.
Right. Okay, there are a few more questions, but I want to take this opportunity. I was thinking to do it at the hour mark, but maybe just do a quick demo of the Rally Tax website. There are tons of, I think, people who have tried out the or joined the waitlist and tried out the demo. I just want to show this for everyone so people know how does it work. Okay. So you should be seeing the Rally website. We say cut your taxes in 60 seconds. We make this easy in under a minute. What does it mean? Basically, we help you to identify what would be your tax savings given your profile, and that's the starting step, to let's say implement or realize that. There are other there are tons of strategies that you could implement, and we help do that as well. So let's try one. You could upload your 1040, which you have, let's say, filed last year or maybe before that, or estimate without it. You could put up your income range, add some profile, and let's say click on get free tax plan. Great. So now you see like, okay, here is something that maybe a range potentially from 60,000 to more than 300K that you could save. We don't tell you a number, but we also tell you that what are the strategies that you could implement to realize that. And here is an exhaustive list that we pass on or evaluate your preferences through different strategies, starting with, let's say, solar tax credits. And we go deep into understanding and telling you that why this strategy fits you, what is the eligibility criteria and requirements, and the recommended steps for implementation. Other strategies, and these are not just simple or vanilla, let's say 401k or Roth, but we go deeper into helping into implement complex strategies such as CRUT or solar tax credits, even exchange funds and QSBs, particularly for founders. And we also have an AI assistant that we have built up. You can actually chat with your tax plan. Let's say if I click one of those pre-filled questions, it will actually answer like how do I implement my savings, and you can further chat. It has a good context of the plan that is created here as well as a general context of a CPA. Now you could also download a tax plan which will give you a PDF, or you could book a consultation with our team to get on this journey. We are on waitlist right now because we are receiving a ton of interest. So do join the waitlist, but feel free in the meanwhile to create a tax plan and download it so that we know and we can reach out at the earliest. Thank you.
Great. Looks really promising.
Yeah. Okay, so we have still 9 minutes. I'm happy to stay as long as Srikanth is here. So
yeah, happy to answer any other questions if there are.
Yeah, I think okay. So can we get back an ETF instead of a basket of 500 stocks if we even exit after 7 8 years, since the fee is high for private investment than an ETF?
Yeah, that is exactly what we've done. After 7 years, you're able to withdraw an ETF, which is very low cost, probably 10 to 15 bips, and keep it in your portfolio until you need the liquidity.
Can we pull those stocks into other platforms like Fidelity?
Yes, we have had incoming stocks from every brokerage in America.
Great. How can I defer tax if RSU is already vested on E-Trade and I have capital loss since vested? Shall I do in-kind transfer of local non-registered account and then move to TFSA in Canada? I hope Srikanth, you're also reading so that
Yeah.
you
So
don't
if
lose
you
the.
have a capital loss since you vested, there's really
Yeah.
no need for an exchange fund. You can book that loss against some other capital gain that you have in your portfolio.
Makes sense. After 7 years, if someone redeems, they will get a basket of stocks, right? What is the cost basis for that?
The cost basis is cumulatively equal to the cost basis of the stocks that you came in with. It will be exactly equal.
Is it similar to direct indexing?
No, it's very different. Direct indexing relies on tax loss harvesting, that provision that the tax code has. This is more like kind exchanges that we were talking about. But yeah, I'm reading that question. We will also offer other products that will help with concentration risk.
I think there's a question about fund performance, but I guess you just started like 18 months ago, so
Yep.
you don't have 3, 5, or 10-year CAGR.
Yep. And as I say, what we're trying to do is index performance. We do not want to be an active manager that is built around fund performance or alpha.
IRA, can we pull it from IRA?
Yeah, IRAs are already tax deferred. So if you have stocks in an IRA, you can easily rebalance.
Yeah, maybe we can call it off now. Cool. Thanks. First of all, thank you for the engaged audience. We still have like 35 people. I'm seeing the metrics. 200 plus people joined. They came in and out, and there were 100 more than 100 people at the 1 hour mark. So great presentation, Srikanth. Kudos to keeping and to Aaron as well to keep everyone engaged. Yeah,
Thanks so much, Hemant, and thanks for the great audience that you put together. These were really, really thoughtful questions. And it is a very nuanced instrument and one that most people don't even know exists. So it is good to engage with this audience, and happy to answer any more questions as you go through our website. Feel free to hit us up.
Yeah. Thank you, Srikanth, for your time today and staying over. Thank you, everyone, for spending your afternoon, evening with us. And we will be back again with an interesting webinar, and we'll keep you posted. Do subscribe to our channel on Luma, or we'll be also sharing this on YouTube. So we'll be looking to post more such webinars or recordings or maybe podcasts coming soon in the future. Stay tuned and do try out Cache as well as Rally. I think we both are working together in a way where it could only save you money, and I think that's a good thing. So with that, thank you.
Thanks, everyone. Thanks, everyone.
Thank you. Bye.